My name's Chris McKay. I've been doing the MC of this panel for a few years. They keep on inviting me back, so I'll keep doing it. I am very upset we missed the dinner last night, not only for a great chance to reconnect with everybody, but I've heard, I got the knife twisted in by Barry this morning that it was one of the best meals yet. I'm pretty sure there was a conspiracy for our aborted takeoff in Richmond, so it'd be more for somebody. So somebody knows that's on their conscience. I also want to put a plug in for the book. Barry told me about that book probably 2 or 3 months ago, and I read it like that. And for a book for that to happen for me is pretty unique. I actually bought multiple copies of it and given it away to multiple people. So encourage you, if you haven't read that, definitely pick that up. It's a great read. Lastly, I just want to say thank you for having us. This is a really special trip for all of us to make. I'm confident of that. It's a really unique group. We're encouraged every time we come here. I am also extremely encouraged when I get a note in the mail from the foundation staff saying they prayed for me and my family that day. I will take all those prayers anytime I can get them, and really appreciate that. What we're going to do in the beginning is we'll start over with Stephanie on my far right. What I'd like everybody to do just briefly is to remind everybody the strategy, a little bit about your firm, the strategy you run for the foundation, and answer a simple question pretty briefly, and that's what is the greatest headwind that your strategy is facing today? I think we will talk about a lot of the good things that we're seeing in our different marketplaces, but certainly investing is a hard an arduous task, and just make a brief comment on maybe one of the biggest headwinds that you're facing or you may face in the year to come. And we'll just go down the line and we'll go from there. Is there a mic down there? No. Okay, well that makes it tougher.
Thank you. My name is Stephanie Batchelor, and I'm from North Carolina. International Farming is a U.S.-based farmland manager. We're established back in 2009. The family that started International Farming has been working and farming in eastern North Carolina for almost 200 years. And that's one of the reasons I joined the firm. I grew up, I'm a 6th-generation farmer from eastern North Carolina. So it's a very, very nice alignment for me and my family to find an investment manager growing in the space when I came back from New York. International Farming today, we have almost 400,000 acres that we own and operate for our investors. We are diversified across 60 different crops, row crop, permanent crop, and specialty crop. We are located in 8 of 9 USDA regions, and we pride ourselves on having operator advantages in the field, in-house agronomy and farm management resources that help maintain and enhance our yield production, and also data services to help us monitor and capture data so that we can improve our processes as we continue to grow and provide healthy food and protect the land for future generations. I think one of the biggest headwinds we're seeing right now is on the trade side with commodity pricing, and continue to monitor that very closely, very carefully. Our growers are certainly also watching the Farm Bill that'll be coming out, hopefully, as folks in Washington focus more on agricultural trade. And given where our growers are right now, we see them as a huge asset in the field. They're very progressive. They're very financially secure, and we support them any way we can with a host of farm and agronomic services.
I'm Charles Honey. I'm the portfolio manager for the long-short equity program at Private Advisors, and happy to be back. Been back several times here. We run the long-short equity portion of the portfolio in an SRI format for the foundation. And I'd say the biggest challenge that we see today, obviously running a long-short portfolio, which means we run our managers run a portfolio of long ideas and then a portfolio of short ideas, and obviously in a market that's gone up 15 of the last 16 years, with the exception of '08, it's been a very challenging period for shorting, particularly given the easy credit environment with quantitative easing. Low rates have created challenges, but we do anticipate that that may likely change. Low volatility has also been a headwind on the short side, but as we saw signs of it in the first quarter, the first half of the year, the volatility can spike up when you least expect it. It has mitigated somewhat in the last quarter, but we don't anticipate now with rates rising and the Fed taking the punch bowl away that volatility will remain low forever.
I'm Ellen Carr. I'm with Weaver Barksdale, and we manage, we've been around since the late 80s for about 30 years. We manage the boring part of your portfolio. We are one of the 2 fixed income managers who is very focused on not losing any of your money, which was kind of hard last week. Charles's gain is our loss because obviously the biggest headwind that we face is rates rising. Fortunately, the portfolio that we manage for you is intermediate duration and very focused on shortening up so that we take advantage of those rising rates and reinvest at higher and higher rates. But I can tell you right now that anyone who invests in fixed income is monitoring Fed policy and investors' reactions to it like a hawk. Hawk is a bad word right now. Like a dove.
Blake Doyle, I'll skip the firm intro since we just did that, but we are the long-only equity manager, so have not had to deal with the short side of things. In terms of, what the biggest headwinds are, I think I'd echo Stephanie's thoughts around trade, but really just general uncertainty for us. When you look at rates, when you look at inflation finally presenting itself, when you look at particularly strength in the U.S. markets, U.S. and Japan, the only 2 markets really up this year, we're paying a lot of attention to what could elongate this cycle, or conversely, is it really, are we getting closer to the end, and trying to position ahead of that. So a lot of uncertainty out there, and I don't think anyone really knows the answer at this point.
Great, thank you. Doug Fry with Reinhart Partners from Milwaukee, Wisconsin. We're the other boring manager in your portfolio. We're more boring. Let's wrestle. We'll decide who's. Well, I'm clearly the most boring because I miss the whole business casual thing, right? And socks optional. You're going to hear from many of your fixed income managers, equity managers, that one of the great headwinds that we're facing, it doesn't matter what your asset class is, rising interest rates is a challenge for every asset class, particularly in a fixed income bond investment. But the other thing that I'd say we're also challenged with in our space as a high quality investment grade manager is, I can go out and buy a U.S. Treasury, which is considered the safest investment there is. Doesn't matter what maturity. If I'm buying a 10-year bond, the U.S. Treasury is considered the safest, most liquid 10-year bond you can buy. Well, when you step away from a U.S. Treasury to buy an agency bond, to a AAA corporate, to a single A corporate, to a high-yield bond, to distressed debt, the further you get away from that safe liquidity, you're supposed to get some reward for stepping into that. Well, we've seen over the past several years, because rates were so low, people have been forced to pay up for risk. And so risk is not rewarded in our market to any great extent right now. So it's become challenging. We're in a rising interest rate environment that we at least believe is going to continue through probably 2019. But we're also in an environment where it's very difficult to go out and find excess yield in any asset class because they're all overbought. So as managers, one of our headwinds is trying to find value in a rising interest rate environment when spreads are very tight.
I'm Richard Patton. I'm from Courage Capital Management, and yield is a lot like socks. It's very hard to find.
Mine are from 3 years ago.
That's good. Matching socks are clearly hard to find too. The headwinds was the question. Is that
Correct?
Is that right? Okay. Lest I veer off. I think the headwind that is most impactful to us is this systemic unnaturally abundant capital. Okay? So the globe is more leveraged than it has ever been in the history of mankind. I think there is a total funded debt of something, one of the fixed income managers can correct me, but I think it's something like $380 to $400 trillion. And I think global GDP is about $70 trillion. GDP is ish a measure of revenues. You know, debt is a measure of obligations, right? So if any one of these people were to come into someone who might have been their boss 10 years ago and say, hey, boss, I got a great idea. I'm going to buy this company. Maybe it does about a 5% EBITDA margin, but I'm going to buy it at 5 times sales, okay? Nobody would be sitting up in here. Okay, so in other words, the point is there's more financial risk in the system than has ever been in the past. And there's 2 ways there's no way to earn your way out of it. Okay? The only way we're going to resolve it is by default. Okay? And there's 2 types of default. One is I'm just not paying you back. Okay? And the second is you lent me $1,000. 10 years from now, I'm going to give you $1,000 back. But the $1,000 that you lent me could have bought these 2 shoes, no socks, and a pair of pants. And the $1,000 I pay you back won't buy you a shoe. Okay? And so they're going to inflate their way out of it. And so that's something that's really important that we need to. Am I finished yet, or can I?
No, you're good.
Am I good? Okay. All right. So how has this affected courage? It's manifested itself in the world of fixed income, not only in reduced interest, in return for risk, but you also have a lack of covenants. Okay, and so what we're always looking for when fixed income enters the world of distress, we said, all right, let's look at the loan packages, because usually the people who lent them the money didn't do that. And what you find in these loan packages is there are no covenants. It's unbelievable. It says, thou shalt not borrow more than 2 times EBITDA, except. And then the exceptions is the next 20 pages of the loan document, which functionally says you can kind of borrow as much as the country of Japan. So, and historically that was okay because we knew that there was ultimately a maturity date. Certainly they have to pay us at maturity. No. We actually have an investment, interestingly, on your behalf in a company called Spanish Broadcasting that went bankrupt, did not make their maturity payment in April of last year. Okay, so this bond has been sitting out there. It's a first lien secured bond paying us 12.5%, and they keep paying us the coupon. Okay, but they defaulted in April of last year. You can't make stuff like this up. And buried in the covenants were 51% of the bondholders, of the bonds outstanding, have to vote to accelerate. Okay, there's one bondholder that has 51%. Okay. Yep. They don't want to accelerate. This is preposterous to me. Meanwhile, the guy who's the CEO of this company he's a thief. He's raping and pillaging in the piggy bank, and he's like taking $10 million a year. If we foreclose on him, we get rid of him, we put a new guy in who's really good, everything will work a lot better. But this one big bondholder doesn't want to use the one covenant that we have to push this thing, into the process it should have. So that's just a function of the fact that there's so much free money that is being caused. The causal factors everybody can talk about. Sorry. You want me to talk some more?
No, I think you're good. Why don't we start over at the other end, and we'll work back this way and meet in the middle. You can hold on to this, but don't get any ideas.
I represent Eventide out of Charlotte, North Carolina. We manage $3 billion in assets under management. in 4 different funds. The Alabama Baptist Foundation uses our Healthcare and Life Sciences Fund, and I know that it's certainly not the boring part of your portfolio, and I hope that it's one of your favorite parts of your portfolio. We are known for finding innovation, and especially in cell therapy, gene therapy, oncological research, and rare disease. Dr. Finney Curavilla, who was with you here last year, spent a great deal of time talking about the things that are the winds that are at our back going forward, primarily an aging population, growing wealth throughout the world, and a greater need for this space with the advancement of technology as well as being able to map the human genome. And so the reality is what is the wind is at our back is also the challenges that are in front of us. Is not many people know about this yet. It's becoming a more common theme in the marketplace. It's a place that even broad generalists don't understand. And so since they don't understand it, often will take on the notion that if I don't understand it, I'm not going to invest in it. And then typically by performance are forced to pile in. So I take it as a great privilege to represent 2 folks that have PhDs, electrical engineering background, and have the ability to not only understand the medicine and understand the science, but know the people that have had success in getting the medicine and the science to the market. So this is a place where our own fortune is also some of our great challenges. People are concerned whether the government is going to come in and cap pricing, but with the advancements that we're working in, that's not a reality. People are looking for innovation and are willing to pay for innovation.
Yeah, hi, my name is Jeff James. I'm a portfolio manager at Driehaus Capital Management. Driehaus is a Chicago-based firm with $8 billion under management. It's been around since 1982, managing portfolios. We have over 10 different strategies, mostly equity-related portfolios, U.S. and non-U.S. strategies, as well as credit and event strategies. I manage our U.S. strategies, mainly focus on microcap and small cap portfolios. The foundation utilizes our microcap portfolio. We define microcap as really using the Russell indices, but while microcap has grown over time, it's still much smaller than the average small cap stock, but around 1.2 billion and under, so essentially 1 billion and under. This is a very inefficient part of the market, the most inefficient part of the market. So we look for companies with rising revenue growth, expanding earnings, companies that are inefficiently priced, less covered than the average small, mid, and large cap company. So we are also a play on innovation, companies that are growing rapidly and really are under the radar, but are gaining coverage and growing rapidly. So it's a play on earnings, on innovation, and we invest across all of the different sectors that are out there. I would say the biggest headwind right now is the rising interest rates and the impact those are having on equity multiples.
Hi, Will Collins, Dean. I'm with Dimensional Fund Advisors. I'm a portfolio manager and vice president based out of our Austin office. I actually am from the area. I grew up in Mobile, Alabama. I sang in Spring Hill Baptist Choir, and I'm glad to be back home, so thank you for having us. I manage probably the boring equity portfolios, stock portfolios as part of your investments. We oversee U.S., international, emerging market portfolios for you guys with a social screen overlay. Those portfolios in combination offer exposure to over 11,000 companies across 44 different markets, and we offer that exposure in a cost-effective, efficient way. Because we are so diversified, we are going to really face sort of broad themes in terms of the overall market movements and aren't going to be looking at any individual companies, good fortunes or misfortunes that are going to drive returns. So I'd say the headwind for us recently has been the underperformance of smaller companies in international emerging markets and here in the U.S. over the last year. But our approach is to offer total market exposure in these portfolios on a consistent basis.
Good morning. My name is Bob DeRoshi. I work with Stonebridge Advisors. We run your preferred strategy, and we're located in Connecticut. We run about $9.5 billion, and we specialize in preferreds. This is all we do. We're sort of in between the bond guys and the equity guys. We're sort of that layer that you want to have for diversification. I would say right now the headwinds that I see from the fixed income side is certainly interest rates. I mean, everyone's been mentioning that, but I think the other headwind is liquidity. That's something that I think you're starting to see. Liquidity has become an issue as volatility increases and you start seeing more selling pressure. And that's something that we're really focused on right now, is looking at that part of our portfolio to manage that downside risk.
Morning. I'm Brandon Zick from Ceres Partners. This is the third year I've been here, but Ceres has been here for 5 years. We've been really happy to manage your money during that time. You have a chance every year to take your money back, and you have us continue to manage it. So that's something we're really proud of and excited about in the future. We actually manage a really exciting strategy. It's called U.S. Farmland. It generates high returns with low risk. And even if you ask what's our worst case scenario 4 or 5 years ago, we would have told Barry and Nathan and Ross a period of sustained lower commodity prices and a trade war. Well, here we are. We've got it. We got exactly what we asked for, I guess. And in the face of that, we still do annually positive, strong returns with a lot of opportunity going forward. So while others here may be, I think, a little more worried about their assets' principal price going down as rates go up, we actually view rates going up and inflation as a huge tailwind for us over time. When you think about how do you hedge inflation, U.S. 10-year tips or 110 basis points now or something, and we generate 5% income every year. So it's a good hedge, it's a good long-term strategy, and we're happy you guys have been with us for a long time.
Hi, everybody. My name is Mark Wallison. I'm with Resource Management Service, which is a longtime timberland investor, so I'm the timber guy. I also don't have any sock jokes. But I guess I'll say timberland is important because it is traditionally an inflation hedge and can offset some of the downsides that we've been talking about today. I think the biggest headwinds I would point out here, and we can talk more about this on the panel, is that I think for us it's delayed real price appreciation for some of our products if enough lumber producers in particular, don't make capital investments as quickly as we have anticipated, capitalizing a lot of the excess profits that they're enjoying at our expense sometimes.
Just a point of privilege, I won't say what's my tailwind, but I will say thank you to the managers. We attempt to have all of them here, a portfolio manager from every firm here, and we did it again. So thank you to you guys. I know it's hard, especially during hurricane season. So thank you all for coming. We do appreciate it very much.
So, I wrote down some themes in advance, and some have been confirmed and voted on numerously. Rates is certainly a topic we're going to get into. That's a topic we've talked about for multiple years. Inflation is one that has been a little bit more recent, but certainly one we're going to pay attention to. And then the newest member of the party is trade war, which we'll highlight a lot more, and that's politically charged but has economic ramifications. Before we get to that, though, I want to start with high-level macro, talking about portfolio construction really quickly with Ross, and then maybe a little bit with Will as well. We've all seen the studies that 90% of your outcome is largely determined by your asset allocation. It's a very misused stat, but the gist of it is where you put the money is the greatest outcome versus manager selection within those categories. Ross, clearly, we saw the results of the endowment portfolio. You and the staff have done a great job of constructing a broadly diversified portfolio, but I've sat in tons of board meetings, investment committee meetings over the last 12, 24 months, and the reality is a diversified portfolio in some people's minds hasn't worked because it hasn't been the greatest return. So you as a consultant, how do you think about constructing those portfolios? How do you have the long-term view to keep that diversification in place? And how do you see that maybe over the next several quarters to several years benefiting the overall portfolio?
Well, I think we have to use history and common sense as our guide. And so we cannot invest, as many do, looking backwards. Certainly if I looked backwards, it makes it a lot easier to understand where we are because I can just look backwards and know. But I have to look forward, and I have to think about, think about the children's home, putting new money in the portfolio, not what happened the last 5 years, but how do we position the portfolio correctly for the next 5 years? And so there will be something like a trade war that comes out of nowhere that we didn't really have on our agenda, and we won't know. So we don't really know what we don't know. And so we have to position the portfolio broadly to try to take advantage of as many opportunities as we can. I think just in the broader sense, too, the market is never perfect, and it's never exactly awful. It's always moving. There's always a pendulum that's swinging towards better, towards worse, somewhere. And it's my job not to know exactly how to position the portfolio, but just to understand as best I can which direction is the pendulum swinging. Is it swinging? Are we improving? Are we having more inflation or less? Are we having higher earnings or lower? Are we having better or worse outcomes from fixed? And so we have to position ourselves the best we can, looking forward, understanding where's the pendulum. So that's what we do. Will, you want to grab the rest of that? Sure.
Thank you, Ross.
And maybe we'll talk a little bit about managing equities and the disparity between international, emerging, small, large. You touched on a little bit in your entry. Expand on that a little bit more.
Sure. Yeah, and Ross brought up a great point. This idea of diversification. I mentioned earlier that we offer you guys exposure to over 11,000 companies across 44 different markets. And really the name of the game is that diversification that, from our perspective, we hope to, or we endeavor to play that role in your portfolio, offering broad-based, efficient exposure to all these companies worldwide. Because at the end of the day, we believe that it's a very difficult thing to know which markets are going to outperform or underperform during which periods of time. 2016 is a great example where we saw the presidency, Trump getting elected. Few, even those who would have predicted him getting elected, would have anticipated a run-up that we've seen over the last couple of years. So it's not only about predicting the right outcome, it's predicting how markets are going to react to the outcome. And markets are very good at incorporating expectations and information. And so from our perspective, offering that consistent exposure to all companies, mega caps, value companies, growth companies, large companies, small companies, is very important in your portfolios, and we hope to offer that exposure on a consistent basis. In terms of what we've seen over the last couple of years in U.S. markets, international markets, emerging markets, we've had many conversations around this idea of, should I be invested internationally? Should I be invested in emerging markets? They've underperformed over the last 9 or so years. I go back to the prior decade, or we refer to it as the lost decade, from 2000 to 2009, when U.S. markets underperformed T-bills for that stretch of 10-year period. And that's not unheard of. That's relatively common back in the empirical analysis here in the U.S. and also in other countries. So it's important to stay globally diversified, to have that exposure to international and emerging markets, even when those markets may not be outperforming in a very given period of time. A diversified portfolio, you're guaranteed to not have the best outcome, but you're also guaranteed not to have the worst outcome. And so that's our mantra at Dimensional.
Great. Keeping the mic down there, Jeff, talk a little bit about small and micro caps. It seems like depending on when you look at the data this year, outperforming, underperforming. Talk a little bit about the background there, the backdrop there, and how you all have done.
Yes, it's been a positive year for the strategy. It's up just under 30% for the year. It's very strong up until September September and into October, when the smaller micro and small cap stocks have pulled back about 10%. So it's been a difficult 6 weeks or so, especially 1 or 2 weeks. However, for the year, it's been very strong. And one of the reasons why smaller equities have done well is strong earnings, number one, strong U.S. economy. The tax cuts and the deregulation have really provided a nice tailwind to the acceleration in U.S. Economic growth that we've seen over the past 4 or 5 quarters versus the last 8 to 9 years. So That acceleration is translated into stronger earnings. We're seeing a lot of innovative companies that are able to operate very well and expand their earnings and their revenue margins and earnings quite well in this environment. And the U.S. economy has held up much better than the overseas economies over the last, certainly over the last year and this year. So that's created an environment where the U.S. has outperformed most other markets, and then smaller equities have outperformed larger equities, really due to earnings.
Great. So maybe pass it over to Bob. I missed the dinner last night, so first and foremost, for those of you who don't know, Bob gives up something every year that he deems as not good for him, although maybe some of those are debatable in my book anyway. So Bob, first bring us up to speed on what you gave up in 2018.
Okay, so last year I gave up French fries, as you know. So this year I gave up cookies. And the reason I gave up cookies is because I'm in a Marriott every night, and I was eating 2 cookies a night, and I looked back and I ate 400 chocolate chip cookies. So I said to my wife, I'm done with cookies. And she goes, well, just give up chocolate chip. I said, no, they got to be all or none. So Barry, I wanted to tell you, I'm going to be writing a book, so someday you can hand out the book I'm going to write. It's called How to Give It Up. And in a decade, all these things that I've been giving up, I'm going to write a book about. So someday you'll have a book to pass out. Anyway.
There is a little bit of a caveat. When he turns 70, he's allowed to start adding something back. So
yeah, I get one back when I'm 70. So I'm going to have a full menu.
Maybe he's planning a sequel for that.
It'll be 30 years of giving up stuff. So the first one I'm getting back are potato chips.
He already knows that. Bob, so let's transition a little bit to rates. We'll start with you. Talk about, you commented earlier in your opening that you sit between equities and fixed income. So how has rates affected your portfolio? How are you all positioning your portfolio given, maybe first tell us your forecast, what you think rates are going to do,
okay.
And then talk about how that's affected your portfolio and how you've positioned the portfolio.
So last year we thought 3 rate hikes. We got 3. This year we thought 4 all year, and we're going to get 4. We're going to get one more in December. And next year we think 4 hikes as well. I mean, we're in the minority for hikes next year. Right now there's a 10% probability of 4 hikes next year based upon what the market's thinking. But we think there's a lot of things that the economy is going to be a lot stronger. We're seeing inflation accelerate. And to us, it's going to be all about positioning this strategy properly. And we feel within preferreds, we're positioned correctly for your foundation. What we're buying are fixed to floater preferreds. So we actually want rates to go higher. So what that means is every time the Fed raises, at some point, these things are going to float at a spread over LIBOR. But right now, we're paying you a fixed rate coupon of about 6%. But as the Fed raises rates next year, and let's say they do 4 more hikes and 1 this year, LIBOR is going to be at 3.5. The average reset we're getting on these preferreds is plus 400. So that means 2 things are going to happen. Either A, when this thing begins to float, they're going to pay you a 7.5 coupon, or B, they're going to call it away at par. If they call that security away at par, that's great. Give me my money back because I'm going to be able to reinvest that at a higher rate. And if they don't call it away, well, you're going to go from a 6 to a 7.5% rate, assuming we get these hikes like we expect. That's going to benefit your strategy and it's going to protect the NAV. So that's how we're positioning in the rise rate. I mean, this year, we're doing fine. We're down 1%. I mean, I'm not overly concerned about that. But longer term, we're positioned properly. We have over 75% of our fund in these fixed to floaters. That's how we're positioned right now.
Great, thanks. Pass the, I think we're still down to 1 mic, so we'll keep passing the hot potato. Why don't we stop with Doug real quick? You offered a wrestling match talking about if you were more boring, so maybe we get a wrestling match talking about rates. What's your forecast for rates? And we'll ask the same thing to Ellen in a minute. And then both of you comment on how then that impacts the position. Where are you finding value? You talked about this compression of spreads, this thirst for yield that's crowded out a lot of the opportunities. So comment on rates, and then where is there value in fixed income?
Sure, thanks. Well, first of all, let me take you back a couple years. I missed this last year. I apologize. But 2 years ago, 3 years ago, 4 years ago, when we sat in front of you all, we made the comment that we're bond managers, right? Whether it's preferred, largely a bond investment, high quality fixed income. One what we sat and said to you for 4 years was, don't worry about rising interest rates, pray for rising interest rates every day. As a bond manager, as an investor that's invested in the bond market, because the worst thing that could have happened to us as investors, you as a foundation endowment, was that rates stayed at 0% indefinitely, and boy, it felt like that was going to happen for a very long time. So we unfortunately were that small little blue negative number. You know, for the past 5 years, 6, 7 years, we were a nicely positive number for you, providing some nice returns. It's our turn to, you know, to be the ballast in your portfolio, but not the total return. So although rising interest rates are going to make the total returns in our portfolios look a little challenged, the reality is it's giving us the opportunity to reinvest into higher interest rates and give you a reasonable rate of return from your safe money. Where do we think rates are going? We're a similar opinion if you trust the Fed to tell you the truth, which is that they've literally, through their forward guidance, told you that they believe short-term interest rates are going to get to somewhere around 3.5%, perhaps even 4%, depending on the Fed governor and their forward outlook. And that's supposed to happen by the end of next year. I think they're going to be challenged by one thing, and they do have every intention of doing that, and we do believe that that's where they want to go. They're going to have a challenge getting there, though. So far, they've taken short rates from 0 to 2 to 2.25, and they're certainly on their way towards 2.5 by the end of this year. And the 10-year Treasury is stuck at just a little over 3. There's what we call in the bond market the shape of the yield curve. Where is a short-term interest rate and where is a long-term interest rate? And that is normally positive. You know, if you go back a couple of years ago, it was 0 for a 90-day T-bill, and it was 2% for a 10-year, and that's a positive slope. You get paid for buying longer maturity bonds because you're taking on interest rate risk. Well, one of the challenges the Federal Reserve has right now is they keep trying to raise short rates, but long rates aren't rising nearly as much or as quickly as they probably anticipated they might. So we believe long rates are going to put a cap on where the Federal Reserve can go. So if the 10-year is stubbornly stuck at 3.25, which is where it is right now, give or take a few basis points, I think it's going to be really hard for the Federal Reserve to take short rates to 3.5 or 4. The Federal Reserve is not going to intentionally invert the yield curve, take short rates higher than long rates. So what we anticipate happening is it's going to be this battle over the next 2, 3, 4 quarters to see who gives up first. Does the Federal Reserve abandon additional Fed tightenings by raising short-term interest rates, or does the market realize the Fed really means it, and therefore the 10-year goes to 3.5 or 4%? I don't know that anybody has the answer to that. We don't yet. We monitor it. We position the portfolio for the eventuality that one of those two things is going to happen. But that's going to be the tug of war in our market. Oh, and by the way, as an investor, in our portfolios, again, be happy, because now all those 1% coupons that we had to invest on your behalf 2 years ago are being reinvested at 3.5 or 4. So let the 10-year go to 4, let short rates go to 3.5, and your fixed income portfolio at least will be in much better shape.
So these fine gentlemen covered interest rate risks in the market very well. I'm going to take a little bit of a liberty and talk about something that we're very worried about, and which I think you can take some comfort in your portfolios, in fixed income specifically, and that's liquidity. I can't remember which of you, yes, mentioned that. So in preferred land, you're used to dealing with limited liquidity, right? You understand it, investors price it. We have become lulled into an environment of relatively, quote unquote, good liquidity because we think that our bonds are liquid because we've been in basically a bull credit market for since the credit crisis. So what that means is that passives have sprung up in our market. There didn't used to be passive alternatives in fixed income. Obviously, it's gained tremendous share in the equity markets. But in fixed income, I think it's about 20% of the overall investment-grade fixed income market now is invested in passive alternatives. What that's doing is providing the illusion of liquidity for an asset class that is not nearly as liquid as equities. Bonds are different than equities. There are not exchanges. It's an over-the-counter market. So that means that for every transaction you do, you either have to find somebody on the other side through a third party, a broker, who matches up buyers and sellers, or you have to get a broker to short you a bond if you're trying to buy it, or out of the goodness of their hearts, I guess you could say. What I'm really worried about, and we spend time thinking about in your portfolio, is what happens in the next bear market, whether that be a rate bear market like what we're seeing today with rising interest rates, which the market kind of knows how to price and can monitor, or whether that is a credit or a risk asset bear market, in which case the non-treasury components of your portfolio, the investment-grade corporate bonds, the mortgage-backed bonds, high-quality bonds, but still those that trade with some sort of spread over interest rates, what will happen when investors pull their money out of these passives? They'll be able to sell the mutual fund, right? You can sell BND, that's the ticker for the Vanguard Total Bond Index, but you may not like the price you get. And meanwhile, those of us who are active managers will be dealing with the literal, sorry to use this word, puking of bonds by these ETFs and these passive alternatives into our market. One thing I think you can take comfort in is Ross has done a great job of picking all of us and has found, among other things, managers who are small and nimble and can take advantage of these types of opportunities. So our firm is not PIMCO. It's not one of the big firms that is literally like moving the Titanic, which we saw on the screen earlier. Sorry, that might be my gong show moment. But we can be more nimble than some of the bigger players who I think will experience quite a bit of dislocation when the next credit cycle happens, because we know it's going to happen. It's just a matter of when.
Great, thanks. I think Bob had a quick follow-up. That was actually a taser. Bob tasering me, saying he wanted to follow up.
You know, one thing I wanted to mention on the bonds, on treasuries as well, is I think the curve doesn't invert. I think at First Trust we believe that it's going to shift as the Fed raises on the short end, because you look at spreads between the 2-year and the 10-year, where's that 22 basis points? The curve is actually steepened now. It's at 33. I know it doesn't sound like a lot, but that's a big move in the last 3 weeks. And we expect to see the 10-year at 3 3/4 to 4 by the end of 19, assuming we get these rate hikes. And the reason we don't think the curve inverts is we don't see a recession. So earnings are growing at 20% this year and 10% next year. So we don't see a recession on the horizon. And that's sort of what we're thinking about on our end, is how you position for that rise in rates. Because we think it's happening, finally. And we need it, believe it or not.
Great. Charles, maybe see if the mic does work, doesn't work. Okay. All right. Talk a little bit, just following up, maybe finishing on the rate section for now anyway. Within the hedge fund space, and specifically long short, where we're buying companies we like and hiring managers that are selling companies short they don't like, how will this potentially continuation of the rising rates help or benefit that strategy?
Sure. So in two really important ways. One, when you run a short portfolio and you sell companies short, right? So you're borrowing a stock that you don't own and selling it, and you're receiving cash. That cash sits in a portfolio, and when rates are at 0%, you don't receive any interest on that cash. Well, when rates were, go back 15 years ago or whatever, when rates were 4 or 5%, you were getting a pretty nice tailwind because roughly half your portfolio was earning 4 or 5% short rebate, and that was providing a couple hundred basis points tailwind to your portfolio each year, and that effectively has gone away when zero interest rate policy kicked in. So as rates rise, we actually start to see more income from the short portfolio. So that's kind of a structural aspect of it. I think the more investment-related aspect of it is that, easy credit, what you have seen is that a lot of, poor companies that you would expect would be long gone out of business a long time ago, have been able to continue to kick the can down the road and raise credit because of, easy covenants, as we covered, and other things that, frankly, these equities should have gone to zero a long time ago. But because of the easy credit environment, they've been able to effectively extend their duration of this company's life, bad management, crooks, and other things that we find are real opportunities in our short portfolio, and it has been a challenge because if those companies don't go away, it's hard for us to profit from them on the short side. So obviously higher rates creates more of a headwind and creates more difficult so that your better companies are do better and your worst companies do worse. So the spread between your winners and losers widens. You start to see more dispersion in the portfolio, and that's really where we benefit. We don't necessarily need markets to go straight up, and we don't need markets to go straight down. What we need is a dispersion between winners and losers, and that's where stock pickers can make money.
Great, thanks. Richard, maybe just following up on this, I saw, you talked about this idea of, financing, the covenants changing, meaning what borrowers can get away with. So it's clearly a theme that you've observed. What other positive or negative themes, in addition to that, or maybe expanding on that, have you seen concern you, you're looking forward to changing, and how will that benefit your investments? Try to weave in a medieval French philosopher into this if you can.
I'm working.
Extra points.
Does this work still? Great. So the trends that I've seen is let me back up for a second. The feedstock for what we do at Courage is 2,000 plus leveraged buyout firms plying their trade in the United States right now. That is what creates leverage that ends up in the system on the corporate side. And all of these firms are staffed by really, really brilliant people who do really, really brilliant things with these companies, and they don't ever buy at auction, and they create a lot of operational improvements after the purchase. Not, okay? And so they have been tremendous, actually, by and large, so it's an 80-20 rule. We'll use Pareto. We won't use a French person. We'll use Pareto. So 80-20, the 80-20 rule being in force here is 80% of these companies are purchased at auction, which means that the buyer is paying the maximum possible price using the most optimistic assumptions, okay, to validate his decision or her decision. And so post-acquisition, what you have is a company that was purchased at, say, well, they will say we bought it at 10 times adjusted EBITDA. We're going back to like 1999 accounting now. And that's adjusted EBITDA means EBITDA before all the bad stuff. All the bad stuff is expenses. So really they're paying like some monstrous multiple of revenues, okay? And really, really small changes in either the industry dynamic structure or changes at the company put these companies in severe peril. And it seems to happen about 50% of the time. And so now you have a lot of companies out there that are financed at around legitimately, probably the debt stack is 12 to 14 times EBITDA. Let's forget that you have to spend a little capital to maintain these enterprises. So they're barely making their interest payments. Okay, interest rates being up a couple hundred basis points is catastrophic for these companies. They become immediately cash flow negative. At the same time, the interest deductibility rule change in the last tax code is really meaningful also. That's a long way of saying that there are going to be a lot of cows coming back to our barn here pretty soon.
Cows coming back to the barn, I like it. Maybe transitioning to farming real quick from that great transition you gave us, Richard. I appreciate that. Stephanie, can you talk a little bit about one of the reasons that I've heard for farmland and timber, for that matter, investing is a hedge against inflation. So, at the high level, can you talk to that, and then drill down? I heard something in your intro that said you have 60 different crops. Talk a little bit about that diversification. I remember a few years ago you guys brought like alfalfa shirts or something to the meeting, and so maybe give us an update on alfalfa towards the end of that. But more broadly, looking at how is farmland and what you do a diversifier and a hedge against inflation?
Thank you. So our farmland currently is diversified in 8 of 9 geographic growing areas so that you can have production consistency with your contracts with your food buyers. That's very important so that you're not over-concentrated in either one crop or one particular growing area in case you have a hurricane or something like that coming through. And where that diversification is very important so that you, with these 60 plus crops, If you've got permanent crops in the Pacific Northwest, or in Florida, or in California, if you've got row crop, up and down the central area of the United States, and specialty crops diversified east to west, you want to be able to provide supply in different environments. And those crops have different pricing attributes attached to them. Right now, you're seeing a lot of pressure on the commodity crops, and where we see opportunities there are with scale. And when you can have larger farms that are more efficient and able to help your growers with pricing inputs or services, that's a huge benefit to them, where margins are currently running very tight. With your specialty crops, having infrastructure and technology and a data platform to help you on the transparency side to become more attractive to food buyers as they seek to diversify their supply chain. So that's where we get excited about diversification and scale. We're trying to help our growers with these services, with data, bringing them more information so they can make more critical real-time decisions in the field. And we, as farmland, as an investment, an inflation hedge, that's very consistent historically. Interest rates rise. We feel like we're very well positioned to continue to grow that asset and continue to support our farmers.
Great, thanks. Brandon, maybe sticking with farming a little bit, or not a little bit, sticking with farming period, talk a little bit about the diversification. As I recall, regionally, you're in a different area, out of the hurricane zone perhaps, but into maybe drought susceptible areas or the like. But talk a little bit about how you guys look at what you're doing as a complement to IFC. And I seem to remember talking about technology and some of the new technological trends that you all are working with, and maybe expand on that.
Sure. The first thing I'd say is our strategy is really simple. It's buy low, rent high. There's no financial alchemy. If I can't explain it to you over a coffee, then you shouldn't be investing in it. It's pretty straightforward. And the market is really inefficient. It's really rare for all of you to see two farmland investment managers in the same room. It's kind of like a unicorn. We don't really run into each other very often, and if we do, we'll lose every time in terms of buying something, because we just target higher returns than everyone else with lower risk. So, we're not looking to be diversified across 9 out of 10 or 10 out of 20 or whatever regions across the country and the world. We actually are just trying to take the core asset, which is U.S. row crop, Midwest farmland. So if you think of it in a bond portfolio context, this is the core. If you only own one thing, it's the highest quality, the most competitive market for farming, the best infrastructure, the best land, period, end of sentence. And we actually generate higher returns than our index and our peers buying core, while they all do core plus. So as you go to all these other regions of the world, you better get paid for that risk. And we think most people don't, to be frank. So, we're laser focused on what we do. We think we want to be, we're in 10 states. And if you think about the investment universe in 10 states, there's more land there than we could ever buy if we had essentially all the money from every institution in the world. Institutional investors in our space are only 2%. So if we run into someone, it's a mistake. We actually compete against farmers. When we buy land, we aggregate farms over time. So while there has already been an institutional roll-up in other industries, whether it's buying companies with leverage, taking them private, timber, all these areas, we're actually doing that institutional roll-up. And the less we run into other investors makes the market more inefficient and generates higher returns over time. On the inflation front, I will say, the beta in farmland is inflation plus productivity gains. And that's historically been what drives kind of the beta in the market, but there's no cheap beta in farmland. There's no index, there's no Vanguard fund that you can buy for 2 basis points or 0 basis points at Fidelity and have exposure to farmland. Traditionally, it's been you have to buy a farm and figure out how to manage it. There are managers like us and others that do it for you, but over time we'll figure out how expensive that beta really is and who generates the excess return. And we've been doing it for 11 years, and I think our track record speaks for itself.
Great. Mark, something that we've talked about right to your right in today about hurricanes. I know there's other natural disasters in timber, obviously with fire and the like. How do you all think about diversification and hedging against that, or protecting against that? And then the second question that I'd like you to sort of help us transition into is, how does the threat of trade war affect your strategy and how you look at allocating resources?
Sure. So I'll try to address those in turn, but I think the biggest risk that we look out for, the biggest black swans that I try to look out for, is it's not in fact natural disasters or natural disturbances. And in fact, some of the best sustainable forestry practices are trying to mirror natural disturbance patterns and encourage the right kind of regeneration. And that's part of the alpha that we generate in forestry is on the small edges in management over a long period of time. So I think what we look out for more is diversification. So our biggest black swan is usually if it's very much on the acquisition side. If you're looking at a piece of timberland, however larger forests offer more diversification from an end market standpoint, the end buyer standpoint. Those end buyers are, what different types of mills accept different types of trees, different quality trees, at which times, so that we provide income streams throughout the life of the forest and also maximize the highest value products, which are saw timber that goes into lumber and construction. And I think the biggest mistakes I've seen other managers make is, timberland also suffers from many other assets here where there's too much money chasing after too few deals in many cases. So people will buy properties without really considering the risk inherent in them. And so I've seen properties where most of the revenues came from one mill, and that mill then shut down. Not an RMS property, but I've seen it in the industry. And so that's the kind of risk that I really look out for, and I'm really concerned about. And I'm spending more time myself as looking over our U.S. investments, thinking about the end markets of our end buyers and how that impacts us ultimately and our clients. So I would say that's the biggest risk I look out for. And trade war is not, it's a point of concern for us. We've been doing a pretty good job of actively cultivating export markets in North Carolina and in the Panhandle, which haven't really existed before, but with our scale, we've been working with some export buyers that do sell to China, but it's such a small part of a core southern timberland portfolio that it's not a major risk area for us. It's some of the upside that we've been bringing as an active manager, but it hasn't impacted us because the timberland markets that are more exposed to trade war issues are Canada and the Pacific Northwest. U.S. South, so much of it is domestic and local, some more or less localized consumption. And so for us, the edges, the risks we look out for are what's going on with our end buyers, and when will we see, how can we get more real price appreciation in what we sell.
Great. Blake, I think we talked earlier about trade, concerns that you all may have. So how does your firm think about the trade tariff issues, and specifically, how does your firm address risk and manage that risk?
Yeah, trade is definitely, when we think about kind of the most pressing concerns for us today, it's up there on the top of the list. The problem is guessing congressional policy or presidential policy has been somewhat of a fool's errand for a while. So it's something we pay close attention to, and what we really look at, especially with regards to your portfolio, is a lot of people focus on country of domicile, but the reality is markets are global, companies are global. We own an Italian stock that has 8% of their revenues in Italy. So these companies are global, but more so their supply chains are global. And so when we're looking at our exposures to potential trade war, to potential tariffs, we are looking at kind of the underlying revenue exposures of the companies that we own, and going a layer deeper to understand where their supply chains are. There are many U.S. companies that are actually going to suffer if we end up putting significant tariffs on China or some of these other companies. And we just don't think that the ramifications are fully understood. in addition, when you look at the impact that trade war could have on the economy versus the market, they're starkly different. And so, as a percent of GDP, as a percent of the economy, it's important. It's not necessarily, disastrous. When you look at a percent of the S&P 500 companies and the companies that could be exposed from a market standpoint, that number is orders of magnitude larger. And so you're really going to look at a larger impact on the market than you will the economy from that. And so we're really constantly looking at what we own, where their exposures are. More broadly in managing risk in the portfolio, we have taken steps recently to lower the beta of our portfolio over the past few months. When we look at trade war, when we look at volatility that, as somebody mentioned before, has been historically low for a long time, and it's just not going to stay low forever. When you look at money growth slowing, when you look at unemployment at historic lows, there is going to be some disruption coming, and we want to be prepared for that. So we run a very diversified portfolio, even though we only have, say, 35 stocks. They're well diversified across sectors, across economies, across geographies, and we think that the way we're positioned with a bit more of a conservative approach than some today in lowering the beta is making us better prepared for what may come. But really the best case scenario we see, everyone's talked a bit about this, but is if the economy slows a bit. We think that kind of the best outcome for us as equity investors would be to see the economy slow a bit and really allow the Fed to take a step back. We don't need the economy to run full steam like it has. Fiscal stimulus this year has really juiced S&P earnings to a level that I don't think people even expected, perhaps. And so we'd like to see things slow back a bit, and in that case, we think it can extend the bull market into the 2020s, probably.
Great. Doug or Ellen, any comment on tariffs or trade from the fixed income perspective? Is this a real concern for you all, or is it just sort of current political noise?
I think the bigger concern is what Blake said. We live in an environment where we love to forecast, and you know that your forecast is going to be wrong. That's the one thing you know about a forecast. However, the error bars around the forecast that we build, whether it be for trade or for interest rates, they've just kind of expanded under this environment of not just the presidential administration, but the geopolitical uncertainty. I think bond markets and equity markets, frankly, are very good at pricing what they understand and know. We as analysts can sit in front of our complex Excel models and build a model for AT&T that says AT&T's revenue growth is going to look like this, and it's going to have this many customers, it's going to merge with whoever it's going to merge with. We can make those types of determinations from a bottom-up perspective. From a top-down perspective, when it comes to forecasting any sorts of geopolitical and macro events, you're basically at a loss. You're at more of a loss than probably you were, say, 5 to 10 years ago. And to me, that just comes back to valuations. When you look at valuations, we've talked a little bit about the credit markets and how spreads are very compressed in the high yield market, which is my area of specialty. Spreads are as tight as they've been since the 2008 credit crisis. So before 2008, they did get tighter than they were today, reflecting very, very stretched valuations. But today, they're about to punch through that level. That, to me, is not consistent with an environment where forecasting has become more difficult and visibility is more limited because of some of these macro top-down geopolitical factors. So just to go back to where that leaves us with respect to positioning, I think this is the time when in fixed income portfolios you should be upgrading your credit quality, you should be shortening your duration just to make sure that you're ready for those rising interest rates to be able to recycle capital going forward at higher and higher rates. You should be going from unsecured into secured paper. There's all sorts of ways to do this in fixed income. But coming back to the original question, which I did a great job of not answering, I don't have a particular view on tariffs. It's certainly hurting some of the companies in specific sectors, but that's sort of a loser's winner's game. A lot of the companies that it's hurting have been beneficiaries of these trade practices for years. A lot of the companies that it's helping have been waging war against these trade practices for years. Steel is a great example. So I think in the overall scheme of things, it's very hard to know how that's going to play out in your fixed income portfolios.
we've been dancing around the idea that predicting what's going to happen has become more difficult, and the reason is that the marginal player in almost everybody's decision is government. If I go back 15, 20 years ago when I first started managing bond portfolios, I never gave a second's thought to the Federal Reserve, fiscal policy, international trade policies, whether the Chinese, the Europeans, was the euro going to break apart? Was the European Union going to fall apart? We never thought about that for a second. You analyzed a bond based on, taking the AT&T bond and put it into a spreadsheet and saying, can they afford to pay their debt given a certain level of income? It was relatively simple. The problem is that when government becomes the biggest marginal player in everybody's decision, you introduce chaos theory as opposed to relatively predictable financial modeling. And we're not getting away from that. In fact, if anything, it's going to get worse. As every single developed country develops higher and higher debt to GDP ratios, as we continue on this trade war, as we look at populism and nationalism throughout the European Union, introducing a great deal of uncertainty in these decisions, it becomes much less about picking good stocks, building good bond portfolios, and it's more about what's going to happen in the next election and how's that going to change your policies. So being diversified, having a good deal of different assets, being in international and domestic asset classes, I think it all makes more sense, because picking a winner and loser when the government is the biggest marginal player in every market right now is almost an impossible task.
Great, thanks. Interesting. Get that all the way down to the end to lands. One of I think the neat things we had last year was Finney showed us that video of the child with, I won't even try to pronounce or remember the disease that affected his sight, and the revolutionary treatment that was given to him, and then watching him navigate that maze for the first time. I think everybody that was here remembering that gets chills. Is there anything, obviously maybe that's a once in a lifetime type thing to see or hear about, but is there anything that you're seeing in the medical field through your all work that you're having a similar aha moment of, wow, this could really change dramatically the way we treat certain diseases?
Sure. Thanks, Chris. It's one of my favorite parts of representing Eventide is to get to relay back to you some of the good work that you're doing in partnering with companies, allowing us to go out and take long-term partnerships with companies. And just like last year, we have a company we're focusing on. We invested in this company back when they were private, and we helped bring them to the market, and we went alongside with your money as they went through their trials and tribulations. And then this year they had breakthrough technology in DMD, Duchenne's muscular dystrophies. If you all are familiar with Jerry's Kids and Jerry Lewis, the entertainer and comedian, Jerry raised money from 1966 to 2010 annually through that in efforts to fight off that disease. And basically what has happened is in the last year, dystrophin, and so muscular dystrophy is the lack of dystrophin. We've been able to, with another Jerry, Dr. Jerry Mendel, he's from the Ohio State University. It's one time in the fall where Alabamans can root for Ohio State. He was able to slice dystrophin smaller and smaller to the point where they could attach it to a virus. And just like the way that we treated, or with the company that treated last year the young boy, getting a virus into a system, it sounds contrary to medicine, but what they're doing is they're pulling the negative aspects out of a virus, and they attach a whole or healthy gene to that virus, and then they inject it into the patient. And the virus does what a virus does, is attack the cells, and then the whole gene replaces the malfunctioning gene. It's essentially like trading a car part. I don't have the video to show you today. Finney has talked about it, but he's seen a video where 3 different boys were given this treatment, and before they maybe couldn't walk up steps. And then he would show the after. Several months later, they were bounding up steps. And imagine young boys that have really been given a sentence of life in a wheelchair that's going to be abbreviated now out in the field playing soccer. And the original goal was to get 10% dystrophin into the young boys' bodies, and we got as much as 40%. So we're really excited about this, and I hope that you are as well. I mean, because if it's not for money like the ones that you all have given to the fund, that we've been able to partner with this company for almost a decade, we've been able to see great success just recently.
Great. Maybe one last question for Jeff, and then we'll do a quick speed round, which we've done a few years in the past, and I think it's always a fun way to just pass the mic down and back and get a bunch of questions from everybody in the last few minutes we have together. But Jeff, before we move to that, talk a little bit about the themes that are in your portfolio. We heard Blake talk about some of the themes that they're looking at. Similarly, mention a few of the themes that you all are excited about and implementing in your portfolio.
Yes, Chris. So we're bottom-up investors, but there's definitely a thematic and a secular nature to some of the companies we invest in. Within biotech, precision medicine, precision oncology companies with very targeted therapeutic outcomes where the response rates are much higher than they've been under past therapies, where the efficacy is, the safety is almost placebo-like, is allowing much better outcomes within oncology patients. Another area that we've been overweight really this entire decade has been cloud software, software as a service. It's really been a huge migration and continues to be as corporations, enterprises move their software offerings not only from an on-premise, very expensive and maintenance-intensive solution to a cloud solution, which is much more favorable from a cost perspective, and it's great for the individual companies because it's recurring revenues and they have great revenue visibility. Within consumer, there's a number of different companies that are doing very well as the consumer is very healthy. They've deleveraged their balance sheets and are spending at a much better clip than they have been earlier in the cycle. So those would be three major ones.
Great, thanks. We'll get the mic back to Lance, and we're going to go through this speed round. And by my watch, we've got about 10 minutes left in our 90-minute session. So I've got 4 or 5 questions that we'll do. If we've got a few minutes at the end, I'm sure anybody would be happy to take any follow-up questions from anybody in the room that might have one to follow up. So try as best you can to answer this first one in as few words as possible. Not that that's aimed at the person to my right. But simply have Trump policies, economic policies, take everything else out of the equation, his Twitter account and everything else, but has his economic policies been beneficial to the economy and or your strategy?
It's been definitely beneficial to our strategy. Most of our investment research goes into the U.S., mostly in smaller and medium-sized companies, and they have been insulated from a lot of the concerns around trade wars. We've also had true organic growth, and in a world where it's been difficult to show organic growth, the market participants have really gravitated towards the types of names that we're buying in innovation.
Same question? I would say overall positive. Deregulation and tax cuts have accelerated the U.S. economic growth and have created an environment for better earnings. And on the tariff front, it's been rather mixed. It's created a lot of, it's been good for U.S. companies, and however, it's been good for U.S. markets, been good and bad. It depends on which sectors you look at. And it's good that some of these agreements are coming to be solidified with the new NAFTA and others.
I don't know if I could interpret whether it was a good or bad thing for our strategies. I can tell you what happened. After the election, we saw small companies take off like a rocket. It was the biggest small cap premium we'd seen in many years. So that's what happened. As far as interpreting what the market was doing to internalize that new information, we kind of leave that to the market.
Yeah, I think it's been beneficial. I mean, you're taking out 80,000 regulations out of the economy. It allows businesses to get more things done. It allows CFOs to make decisions and CEOs, and that's definitely benefited our strategy as well because rates are going up and the economy's improving. That's good for everybody.
Yeah, I'd say certainly from a tax and regulatory standpoint, it's been really beneficial. Certainly on the trade side, we think it's a short-term headwind, long-term tailwind as deals are worked out. And as NAFTA has been redone, that's a big plus. And we think over time, the issue with China will certainly be worked out.
Some might say net positive, but subdued and indirect. I mentioned trade war has not been a big issue with core southern timberland, but the concerns I would have, and however you assign the drivers of this, but I'm still concerned about housing affordability and housing start recovery. But on the flip side, we also benefit from the increase in repair and remodel, which is part of a consequence of that.
Yes.
No. No. For all the reasons just mentioned, tax policy, deregulation, and the one main concern that I think we have as long-term fixed income investors is a total lack of fiscal discipline on the part of Congress. $1 trillion, you're looking at unbelievable deficits at a time when the economy's roaring. We should be saving money, not spending excess money at a time where we look at long-term budgets that are just you can't even fathom how bad the long-term budgets are, and we can't even get a short-term budget to work. So for a lot of those reasons, from an immediate business standpoint, very positive, but total lack of fiscal discipline is a very big concern of ours.
Yeah, at the risk of echoing everyone else, I'd say yes, for sure, in recent history, and deregulation is a big one. On a more specific example of that, at the FDA, the leadership we've seen there, we're invested in a lot of the same genomic, personalized medicine, molecular medicine type companies, and the ease at which you're seeing some of these get approved or move forward is different than we've seen in years past. So that's been helpful. But we share the same concerns long term. What we look at, the great debt swaps since the crisis, which is consumer debt really having gone down, but it's been more than replaced by the increase in government debt. And so while consumers are doing a better job saving and households are, the government debt is just terrifying.
So I'm going to answer two ways. The first way, I'm so glad Doug brought that up and Blake echoed it. I agree on the profligacy issue. I have a colleague who I believe is a genius who has spent a lot of time studying the history of financial crises. He goes all the way back to Pompeii, which he views as the first financial crisis. He's got a whole presentation on it. But he reminded me recently that the last time the government pursued a stimulus program in the middle of an economy that was booming like this was in 1929. Now, that was a monetary stimulus as opposed to a fiscal stimulus, but that certainly was something of a sobering moment for me. With respect to high yield specifically, I'd say the impact has been a little bit more mixed because high yield companies generally don't pay corporate income taxes. So the corporate tax aspect of what's happened in the Trump administration has been not much of a boon for them, but all of the regulatory issues that people mentioned have been helpful.
I'd say overall it's been mixed for our portfolio. Certainly tax cuts have benefited small companies, which has helped some of the smaller companies on the long side, has certainly created some headwinds on the short side. We don't have a lot of emerging markets exposure in this portfolio, so that has not been an impact because that's clearly been where the pain has been felt the most this year as those markets are down. We continue to see, broad dispersion between value and growth, and I think a lot of that has to do with the passive activity and the continued movement into the indices where things have worked. I think part of the challenge of tax policy and trade and all these other things is these are long duration decisions that have impacts hopefully over the next several decades, and you're dealing in an equity market that has an average holding period of less than 5 days. And so I think it's sometimes hard. People try to predict and have a hard time taking the longer term view that eventually things will probably work out, and as usually they do.
Generally, yes. As a long-term holder, both of my family's farm and as a farmland manager for you, I hope we're trading some short-term pain for long-term correction.
Great. If you could invest in one thing over the next year and your downside was insured, so in other words, you didn't have to worry about downside. We've talked a lot about downside, and appropriately so for what we're doing, but if you could invest in one thing over the next 12 months, and your downside was covered by insurance or the invisible hand, what would you invest in over the next 12 months?
Ag tech. I think it's, I have a little bit of a venture capital background, and but just as farming continues to innovate, and this whole sector is consolidating and changing so quickly, I think small movements in capital to support new technologies for farmers will be huge.
Obviously, we see a lot of strategies and a lot of different things. I think the most interesting thing I've probably seen in the last few weeks, if I'm looking at over the 12 months and have no losses to worry about, would be advances in gene technology and medicine. I think you're at the cusp of seeing some really incredible innovation there. It's going to do some great things for the world and a lot of people that are in sickness.
Puts on the U.S. dollar.
I'll echo the gene therapy and really molecular medicine. We like the picks and shovels approach, so the enabling technologies rather than picking a specific therapy, some of the hardware and enabling technologies that are going to allow for that growth.
Bond guy, I don't think this way.
I'm freeing you up to not take off your socks while you're at it. Live a little.
Time's coming up. I mean, certainly an area that you look that's transformative, that gene therapy and the like, but certainly anything having to do with transportation automation. I mean, I'm a pilot. Anything having to do with automating aircraft, driving technology, trains, shipping, everything's moving towards that. So anything that you can get into those, the cutting edge movers in that space, I think have just unlimited upside.
A specific company, Novocure. It's been successful treating glioblastoma and mesothelioma using, I would say, physics rather than pharmacology. Its next 3 targets are small cell lung, pancreatic, and ovarian, which are all solid tumors also. And if you are able to make the leap, have I gone too far?
No, you're good.
Okay.
You're saving up from your yes answer there.
Yeah. So the notion is that the physiology of solid tumors is different than their genetic or makeup, and therefore treating them using physics to treat the glioblastoma successfully and using physics to treat the mesothelioma solid tumor effectively would lead one to believe that the early successes they're seeing in the 3 cancers I described earlier, non-small cell, pancreatic, and ovarian, have a high probability of being successful. Should that happen, this is, something I think the stock price is like in the 40s. I think it could be in the 300s.
So I would say lumber producers, and maybe more second level thinking is the firms that provide highly automated systems for those lumber producers investing in the South.
When you take out all the risk, this makes this pretty easy, which I think is kind of why it's more difficult to invest in these spaces. But I definitely agree with Stephanie on the ag tech side. There's so much that can be done to reduce labor cost, become more efficient, for food safety. These are all things people want and need, and I'm all for all that, because when you own the land, eventually all those benefits come to you.
All right, so I'm the bond guy. I'm going to go on the equity side, though. I'd say biotech. We really see a lot of opportunity in biotech going forward in the next decade with all the advancements, so that's my choice.
So no risk of downside. I would invest my time watching Auburn football. But given how the season is unfolding, I don't know if the risk of downside, I think, is still there. No, in terms of investing, though, I think our plan, our approach is to offer long-term allocation to those segments of the market that have been shown to outperform over time, which are companies trading at low valuations, high expectations. So that would be where I'd focus my efforts.
I'll mention a sector that has not been mentioned. It's energy. With the price of WTI, West Texas Intermediate, around 75, Brent around 85. Prices are now at a level where it will improve utilization and day rates and capital spending. Long-term energy has a lot of secular issues with climate change, but short-term, I think the energy sector should do well over the next year.
Well, I'm thrilled that several of the other panelists have supported what Eventide's core competency is, and it goes against the grain of the question a little bit. But if you wouldn't partner with a company for a decade, I wouldn't partner with it for 12 months. And so we would encourage you to find a company that's creating value for society and will create value for decades to come, and look at it as a long-term business partnership. Obviously, within healthcare, we think as a firm that your children and your grandchildren will look back on this, the way we've treated medicine and the way we've treated patients today, in the same way that you and I might look at the way people use spears and leeches. So I would encourage you not only to take an investment in biotech for this 12 months, but to have a portion in your portfolio that's just not for sale, because this is going to be something that's going to be materially beneficial over the life of not only you, but your children.
Great. All right, last question. And you can't use any of Barry's books because that would be kissing up, but your favorite book or most interesting book that you've read over the last year or two?
I've spent a lot of time in the Gospel of John, and I think as someone who would call himself a follower of Christ for 12 years, I was amazed at the miraculousness of Jesus through this time. I think we all take for granted the miracle that he is and was, and sometimes we get immune to the story and a little numb to the story. So it was really fresh for me in revisiting the gospel.
I do so much reading for the markets. I do not have a good book to recommend of late. I've been very much into podcasts, whether I'm in my car or going for a run. There's so many different interesting podcasts on investing, on history. There's just so many to choose from. I would recommend a good podcast.
I have an equally geeky answer, which I was lucky enough to study under Gene Fama, who won his Nobel Prize and has been intimately involved with Dimensional for many years now. In 2013, and there was a book that was recently released that has his collected works, and it's, as a guy who's been involved in finance over the last 50, 60 years, father of the efficient market hypothesis, all this kind of stuff, it's a really great synopsis, summary and a holistic really view of all of his contributions to the field, so that's what I'd say.
The book that I recently read was The Secret of Success, and it's not just financial success, but it's life success and how that influences your thoughts and how to manage money. I thought that was a great book.
I'm going to give you a pure pleasure read. Having grown up on a farm in eastern Pennsylvania, I read a nice book called Philly Special, which was about a Super Bowl victory. So if you're from Boston, you probably won't enjoy it, but if you're from where I am, it was very enjoyable.
I'd recommend a book called The Power of Habit by Charles Duhigg, and it's valuable not only because it helps us manage the lizard part of our brain a little more effectively, but it has some really valuable lessons for organizational change also.
The Gene by Siddhartha, I can't say his last, Mukherjee or something. Am I anywhere close? Anybody? Okay. He's the same one. He's the same author who wrote Cancer, the Emperor of All Maladies. It's very, given what's happening in biotech, understanding what's happening in the gene is a really important thing to do, and it makes it very approachable.
The reason I wasn't with you last year is because I was playing in the deserts of Kandahar in a little military deployment. So I did a lot of reading about the Middle East. A particular book that I enjoyed, given that my deployment was in Afghanistan, was by an anthropologist from Boston College, the Culture and Military History of Afghanistan. And that sounds geeky, but you really gain a great deal of appreciation for why things are the way they are over there, and some of the long-term issues that we have if we want to have victory over there, if we don't understand the culture and the history of some of these countries that we're trying to transform. So that was very educational for me.
So you stole mine. I just read The Gene as well. And,
Sorry, I
no,
I read her homework.
No, it is an interesting book because if you look at what we believed even just 100, 200 years ago about the human genome and what our genes were and how far we've come even just in a few decades, it makes you think about how quickly we're going to have progress going forward. But second choice, I just read a book, Sapiens, which goes through the history of humankind, and I just found it fascinating.
So I was actually going to take yours, Blake, and do two, but I'm going to do two anyway. One for fun, one for business. For business, my idol, who invented distressed investing, with all due respect to Richard, Howard Marks, just released a book called Mastering the Market Cycle. He looks at cycles in all different types of markets. So he's a high yield and distressed debt investor by trade, but he looks at everything from the real estate cycle to the equity market cycle, and I thought it was a fascinating look at investor psychology through lots of different types of cycles. And his basic thesis is history doesn't repeat, but it rhymes, which apparently Mark Twain did not say. My fun reading is Verena, which is the most recent book by Charles Fraser, who wrote Cold Mountain. It is the fictionalized version told in her own voice of Verena Davis, Jefferson Davis's widow. And I had no idea what happened after the South fell and the fact that she and this caravan of people tried to escape to Florida. But it touches on all these cultural themes in just this masterful prose. I was literally weeping by the end of it. I was just blown away by it.
I'll give two as well. One, I think An Empire of Wealth by John Steele Gordon is the economic history of the United States, which is a really fascinating read if you want to know why New York is the financial center and what went on to do the Erie Canal and talking about long-term investments and how the impact. It's a really interesting read. And then for fun, if you're anybody who's fans of the movie The Princess Bride, Carrie Elways, who was the Wesley character, wrote a book called As You Wish, which is the behind-the-scenes story of how that movie was made and how it was filmed. Very interesting.
The Gene seems to be popular today. And then secondly, I've actually been reading a lot of cookbooks. I'm a terrible cook and trying to get better at that. And whether you're cooking for yourself or with your family, I think we should all be spending more time at home and with those ones we care about. And it's a great way to do it is cooking. So.
Great. Well, again, I just want to say we've used a little bit more time than we were allotted, but I just want to thank, on behalf of all of us, for you having us. I think we would all say we are privileged to be associated with your organization, you as people, and your mission. And we really appreciate you having us here. So I'll turn it over to John to wrap that up.